Good day, everyone. My name is Chris Jonas. I'm the Director of Communications at the National Association for Business Economics. We're pleased to present today's event, which is the 9th installment of our webinar series, Perspectives on the Pandemic, featuring leading voices and economic thought leaders sharing their insight with NABE members. We're going to go straight into today's program. Note that we will have Q&A open throughout today's discussion. You can submit a question to the moderators at any time using the Q&A box. At this time, I would like to bring in our two moderators. Ellen Hughes-Cromwick is a former NABE president and currently Senior Resident Fellow for Climate and Energy Program with Third Way. Mark Palim is currently a NABE Director and Deputy Chief Economist and Vice President with Fannie Mae. Mark, I'm going to turn it over to you.
Well, thank you very much, and thank you everyone for joining us. I'd like to start by thanking the governor for taking the time out of their busy schedule to participate in this webinar. Governor Brainard is well known to our audience, so I won't spend a lot of time on the bio. I will note that the governor joined the Board of Governors on June 2014. Prior to that, Dr. Brainard held a number of positions in government, culminating in being the Undersecretary for National Affairs at the Treasury Department. Dr. Brainard got a PhD at Harvard and has taught at the Sloan School of Management. So with no further ado, look forward to hearing your remarks and then having a Q&A.
Well, good afternoon. And I want to thank Tom and Chris for inviting me to join you today, and Ellen and Mark for joining me. We're all, of course, very focused on steering through the uncertainty associated with the pandemic. I think the COVID contraction is unprecedented in modern times for its severity and speed. Following the deepest plunge since the Great Depression, employment and activity rebounded faster and more sharply than anticipated, but the recent resurgence in COVID cases is a sober reminder that the pandemic remains the key driver of the economy's course. A thick fog of COVID uncertainty still surrounds us, and downside risks predominate. The recovery is likely to face headwinds even if the downside risks do not materialize, and of course a second wave would magnify that challenge. Fiscal support will remain vital. Looking ahead, it likely will be appropriate to shift the focus of monetary policy from stabilization to accommodation by supporting a full recovery in employment and a sustained return of inflation to its 2% objective. So let me just briefly touch on each of those points. A variety of data suggests the economy bottomed out in April and rebounded in May and June. Payroll employment rebounded strongly. In May, retail sales jumped 18%, and real personal consumption expenditures are estimated to have increased 8%. Consumer sentiment improved in both May and June, and both the manufacturing and non-manufacturing ISM indices jumped into expansionary territory last month. And financial conditions remain broadly accommodative on balance. But the earlier than anticipated resumption in activity has been accompanied by a sharp increase in the virus spread in many areas. This is a reminder that uncertainty will remain elevated as long as the pandemic hangs over the economy. Even if the virus spread flattens, the recovery is likely to face headwinds from diminished activity and costly adjustments in some sectors, along with impaired incomes among many consumers and businesses. On top of that, rolling flare-ups or a broad second wave of the virus may lead to widespread social distancing, whether mandatory or voluntary, which could weigh on the pace of the recovery and even presage a second dip in activity. A broad second wave could reignite financial market volatility and market disruptions at a time of greater vulnerability. A closer look at the labor market data hints at the complexity. There is no doubt that the improvement in the labor market started earlier and has been stronger than many had anticipated. Over May and June, payroll employment increased by 7.5 million. The unemployment rate fell 3.6 percentage points, and the labor force participation rate rose 1.3 percentage points. That's a sharp contrast to the experience of the global financial crisis when the initial decline was shallower, and it took much longer before a similar share of the initial job losses was recouped. The job gains in the past 2 months were concentrated among workers who were on temporary layoff. They likely were driven by an earlier than expected rollback of COVID-related restrictions as businesses ramped up hiring and consumers exhibited greater comfort engaging in commercial activities, as well as by a boost to employment from the Paycheck Protection Program. The improvement was especially notable in the leisure and hospitality sector, which of course had been particularly hard hit by COVID-related closures in April. However, it's unclear whether the rapid pace of recovery in the labor market will be sustained going forward. The pace of improvement may slow if a large portion of the easiest gains from the lifting of mandated closures and easing of capacity constraints have already occurred. Moreover, weekly COVID case counts have been rising and some states are ramping up restrictions. These developments mostly occurred after the reference period for the June employment report. After declining at a fast clip through early June, for instance, initial claims for unemployment insurance have moved roughly sideways in recent weeks and remained at a still elevated level of 1.3 million in the last reading. The pandemic's harm to lives and livelihoods is falling disproportionately on Black and Hispanic families. After finally seeing welcome progress, narrowing the gaps in labor market outcomes by race and ethnicity in the late stage of the last recovery, the COVID shock is inflicting a disproportionate share of job losses on African American and Hispanic workers. The number of employed persons fell by 14.2% from February to June among African Americans and by 13.4% among Hispanics, significantly worse than the 10.4% decline for the population overall. Separately, on the other side of our dual mandate, inflation has receded farther below its 2% objective, reflecting weaker demand along with lower oil prices in recent months. Total PCE price inflation stood at just a 0.5 percentage point in May on a 12-month change basis, while core PCE inflation, excluding food and energy, stood at just 1% on a 12-month basis. That said, this morning's CPI data for June suggested some stabilization. Although the survey and market-based measures of inflation expectations are somewhat mixed, with inflation coming in below its 2% objective for many years, the risk that inflation expectations could drift lower complicates the task of monetary policy. The strong early rebound in activity owes in no small part to rapid and sizable fiscal support. Several daily and weekly retail spending indicators suggest that household spending stepped up in mid-April, coinciding with the first disbursement of stimulus payments to households and the ramp up in the payout of unemployment benefits, and showed the most pronounced increases in the states that received more benefits. With some of the fiscal support measures either provided as one-off payments or slated to come to an end in July, the strength of the recovery will depend importantly on the timing, magnitude, and distribution of additional fiscal support. At the sector level, there is substantial heterogeneity. Recent data suggests the recovery in sectors such as manufacturing, residential construction, and consumer goods will be relatively more resilient, while consumer services are more likely to remain hostage to distancing. Manufacturing production jumped nearly 4% in May, following its historic drop in April, and forward-looking indicators point to another solid increase last month. Pending home sales and single-family permits rose more than anticipated in May. In the consumer sector, the rebound in spending has been concentrated in goods categories, especially, of course, online, whereas most services categories have remained quite depressed. Similarly, some parts of the commercial real estate market, most notably lodging and retail, are experiencing significant distress and have seen sharp increases in delinquency rates, along with tighter bank lending standards. And for equipment investment, production and supply chain disruptions and high levels of uncertainty continue to weigh on expenditures. In addition to the headwinds facing demand, there could be persistent effects on the supply side of our economy. The cross-border distancing associated with the virus raises the possibility of persistent changes to global supply chains. Within the U.S., the virus may cause durable changes to business models in a variety of activities, resulting in greater reliance on remote work, reductions in non-essential travel, and changes to commercial real estate usage and valuations, for instance. In downside scenarios, there could be some persistent damage to our economy's productive capacity from the loss of valuable employment relationships, lower investment, and the destruction of intangible business capital. A wave of insolvencies is possible. The non-financial business sector started the year with historically elevated levels of debt, and already this year we've seen about $800 billion in downgrades of investment-grade debt and $45 billion in corporate defaults, which is a faster pace than we saw initially in the global financial crisis. Several measures of default probabilities are somewhat elevated. First, it remains vitally important to make our emergency credit facilities as broadly accessible as we can in order to avoid the costly insolvencies of otherwise viable employers and the associated hardship from permanent layoffs. Finally, in keeping with the global nature of the pandemic, foreign developments could impinge on the U.S. recovery. The International Monetary Fund estimates that real global GDP dropped at an annual rate of about 18% in the second quarter, after a drop of nearly 13% in the first. While the potential for a fiscal response across the euro area is positive and important, there has been some renewal of tensions between the US and China, and the outlook for many emerging markets remains fragile. For our part, the Federal Reserve moved rapidly and forcefully to restore the normal functioning of markets and the flow of credit to households and businesses. The forceful response was appropriate in light of the extraordinary nature of the crisis and the importance of minimizing harm to the livelihoods of so many Americans. With the restoration of smooth market functioning and credit flows, our emergency facilities are appropriately moving into the background, providing confidence that they remain available as an insurance policy if storm clouds again move in. While it is welcome news that 7.5 million jobs were added in the last 2 months, it is critical to stay the course in light of the remaining 14.7 million job losses that haven't been restored since the COVID crisis started. The healing in the labor market is likely to take some time. Last month, a majority of the FOMC participants indicated they expect core inflation to remain below our 2% objective and employment to fall short of its maximum level at least through the end of 2022. So looking ahead, it will be important for monetary policy to pivot from stabilization to accommodation, supporting a full recovery in employment and returning inflation to its 2% objective on a sustained basis. As we move to the next phase of monetary policy, we should be guided not only by the exigencies of the COVID crisis, but also by our evolving understanding of the key longer-run features of our economy, so as to avoid the premature withdrawal of necessary support. Because the long-run neutral rate of interest is quite low by historical standards, there's less room to cut the policy rate in order to cushion the economy from COVID and other shocks. The likelihood that the policy rate stays at the lower bound more frequently risks eroding expected and actual inflation, which could further compress the room to cut nominal interest rates in a downward spiral. With underlying inflation running below 2% for many years and COVID contributing to a further decline, it is vital that monetary policy support inflation expectations that are consistent with inflation centered on 2% over time. And with inflation exhibiting low sensitivity to labor market tightness, policy shouldn't preemptively withdraw support based on a historically steeper Phillips curve that isn't currently in evidence. Instead, policy should seek to achieve employment outcomes with the kind of breadth and depth that were only achieved late in the last recovery. With the policy rate constrained by the effective lower bound, forward guidance provides a vital way to provide the necessary accommodation. For instance, research suggests that refraining from liftoff until inflation reaches 2% could lead to some modest temporary overshooting, which would help offset the previous underperformance. Balance sheet policies can help extend accommodation by more directly influencing the interest rates that are relevant for household and business borrowing investment. Forward guidance and asset purchases were road tested in the previous crisis, so there's a high degree of familiarity with their use. Given the downside risks to the outlook, there may come a time when it's helpful to reinforce the credibility of forward guidance and lessen the burden on the balance sheet with the addition of targets on the short to medium end of the yield curve. Given the lack of familiarity with front-end yield curve targets in the United States, such an approach would likely come into focus only after additional analysis and discussion. The Federal Reserve remains actively committed to supporting the flow of credit to households and businesses and providing a backstop if downside risks reemerge. With a dense fog of COVID uncertainty shrouding the outlook, the recovery likely will face headwinds for some time, which calls for a sustained commitment to accommodation along with additional fiscal support. So with that, let me turn back to you.
Great. Governor, thank you very much for those remarks. I'm sure our audience really appreciated them. I'd like to start with a relatively nuanced question. Several times you discussed in your remarks the overriding risks and uncertainties, not only in current conditions, but as well as we look out into the future. Clearly, we don't know the course of COVID and the health crisis. We were hoping that you could provide some insights about how you gauge and address the factors that are really risks that we, in some, as economists, we can quantify in some way, maybe not perfectly, as opposed to the uncertainties out there. Those are the unknown unknowns. And could you comment a little bit about that as a policymaker?
Yeah, that's a very, very good question in current circumstances. Generally speaking, the way I think about it is risks that are most amenable to quantifying have some relatively recent historical experience to draw from. For instance, as we confront the risks and uncertainty associated with COVID, we might be able to draw on measured historical experience to put some bounds around a few things. For instance, the possibility that a persistently weak economy may result in longer run damage to potential growth. For instance, we know from previous such recessions, or from previous recessions generally, that high unemployment and permanent job losses can cause scarring in the labor market. We know that widespread business failures can lead to widespread permanent job losses and can result in the loss of productive, physical, and intangible capital. And we know that all of these factors together can reduce productivity. Historically, in previous recessions, we've seen that the burden of high unemployment falls disproportionately on minority and low-income families. And with COVID, we are seeing job losses disproportionately affecting Black and Hispanic workers. So a persistently weak economy carries the risk of worsening economic inequality, which is particularly troubling given how long it took to start seeing some narrowing of the gaps for these groups in the last recovery. And we also know from previous episodes that inflation expectations haven't always been as stable. And so when we see inflation persistently below our 2% objective, we have to be attentive to the risk that inflation expectations could drift lower, which would make achieving sustained 2% inflation over time more difficult. On the other side, you asked also about other factors that are probably better characterized in terms of being fundamental sources of uncertainty. That kind of uncertainty is unusually high at present due to the nature of COVID. The current pandemic situation doesn't have any real full-blown parallel in recent memory. We still have only limited understanding of the novel coronavirus, making the intensity, the course, the eventual resolution of the pandemic very difficult to predict. Developments such as an effective vaccine or improved treatment options could significantly alter the economic impact of the pandemic, but predicting the timing and likelihood and efficacy of such developments, is quite difficult. and the ways in which health outcomes will affect the economy, and how profoundly that could change structural factors. Those are things that are nearly impossible to assess. Epidemiological models might be able to tell us what the probability, of a national case count of certain amounts might be. But even there, it's not clear what we would extrapolate for the economy, because we adapt, we change behavior, businesses change behavior. So those sources of fundamental uncertainty, as you call them, is why I think we just need to be attentive to how much of a fog of COVID-related uncertainty shrouds the outlook.
And I think, you and Chair Powell have talked at length about the challenges with regard to the labor market and the disproportionate impacts on Blacks and Latinos. And I'm wondering if you would comment a little bit regarding the lending versus the spending authority that you have, and to what extent you think there are elements of the monetary policy tools that you have deployed since March that could address those challenges in the labor market as they pertain to Black Americans and Latinos.
So this is a very important focus, certainly of our research across the Federal Reserve System. And we're very attentive to potential impacts on inequality, which was already quite high coming into the crisis. It matters, of course, for all of the work that we do. With respect to the recovery, I think it's just exceptionally important for us to recognize that it will face headwinds for some time, and that calls for a sustained and a comprehensive framework of accommodation. As we saw in the last recovery from the great financial crisis, is that sustaining a strong labor market delivers great benefits to many families and communities that have too often been left behind. This is a theme that you'll hear loud and clear in all of the Fed Listen sessions that we held across the country, where we met with communities to ask them, how do you think about what Congress has asked the Federal Reserve to do in terms of promoting maximum employment and price stability? What we heard repeatedly was that employment gains came to some communities exceptionally late, and that they face some persistent barriers. So I think what we have learned over the course of the last recovery is that we actually can commit to restoring the kind of breadth and depth in employment outcomes that we saw only late in the last recovery, because of the limited response of inflation to labor market tightness, which economists tend to refer to as a very flat Phillips curve. That means that monetary policy should avoid tightening preemptively in anticipation of increases in inflation that may never arrive, and that in fact that kind of a posture is beneficial both for restoring full maximum employment and also for achieving our 2% inflation goal on a sustained basis.
You have talked a lot about the whole variety of toolkits, tools at your disposal in order to address and achieve the dual mandate defined in our law. And I'm wondering if you could talk a little bit about how different tools potentially have influenced the decoupling between the real economy performance and our financial asset markets. I think a lot of people are wondering what what causes such a decoupling when we see the economy in a very challenged state, but yet our equity markets, our markets seem to be doing well? They're responding to the efforts underway at the Fed. Is there any other information around that decoupling that would be helpful to understand?
Yeah, so I think one of the things that we always have to keep in mind is we expect financial markets and asset prices to be forward-looking, to be influenced by current data, but to be discounting expectations about the future. So to some degree, the financial markets moved earlier and very, very dramatically as it became clear that COVID was going to be a global phenomenon. And it's also true that we've seen a lot more stability, lower volatility, and a more optimistic outlook in equity markets. Now, in terms of might we see some decoupling, again, because our financial markets tend to be forward-looking, that is not unusual. It's also the case that some of the greatest impacts in the economy are hitting small businesses, hitting businesses who are not well reflected in the aggregate equity market indices. And we are seeing a disparate impact on consumer services provided by small businesses, for instance. So there may be some good fundamental reasons for equity markets to look somewhat different. Of course, you would care a great deal to see differentiation among sectors within equity markets. That's very important because, of course, we would expect, it would be natural to expect different sectors to fare differentially going forward, depending on the course of the crisis. And of course, I do think you're right that the very strong policy response on the part of the Federal Reserve and on part of Congress and the administration with a very sizable fiscal response very early on, that did make a material difference, I think, in market expectations and the tone of markets. And that seems appropriate given how much we've seen that fiscal support having an influence on actual spending.
Very helpful. I have one last question before I turn it to Mark so that we can address audience questions that are coming in. Governor, many central banks globally have begun to address climate change in their policies, especially as they become members of the Network for Greening the Financial System or be an active participant in the Task Force for Climate-Related Financial Disclosures. Our investors are looking for transparency and data with regard to climate risks. Will the Federal Reserve also become actively engaged in this effort if, for example, climate becomes the next shock to hit the economy?
Yeah, so it's a good question, and I'm glad that you are highlighting it. I believe that understanding the impact of climate change on financial stability has to be a priority for the Federal Reserve. We know that climate risks are projected to have profound effects on the U.S. economy and financial system. And to fulfill our core responsibilities, it has to be a priority to study the implications of climate change for the economy and financial stability and to adapt our work accordingly. If you think about other potentially significant risks, we have engaged in thinking how they could influence financial stability, whether it be trade conflict or cyber attacks or energy disruptions. This is the same kind of potentially quite significant risk and it's incumbent on us to understand the potential vulnerabilities in the financial system. We have ramped up and made a priority of participating actively in climate-related research and practice. We're making investments in research to better understand how climate change affects the safety and soundness of financial institutions, the stability of the financial system. We are publishing as much of that work as possible, and we're bringing it to bear in our work at the FSB, the Basel Committee, other standard-setting bodies. I believe that the work on climate disclosures is extremely important. We have supported the continued efforts of the TCFD, and we continue to actively participate and think that work is very important. I will also say that while the timeline of the NGFS's activities are somewhat in flux as a result of COVID, the Federal Reserve has stepped up its engagement with the NGFS, and it participates in its meetings. And my own personal belief is that we should become members in order to learn from and share with our international colleagues best practices in accounting for climate-related financial risks.
Thank you very much, Governor. Mark?
Well, thank you very much. I appreciate it. And I wanted to start off, there's a whole bunch of different questions, as you can imagine, that have come in. The first thing, in your remarks, you discussed a little bit the zero bound, and I was interested to hear if you might be able to comment on how we should be thinking about negative rates as a policy tool. As you're well aware, it's been used in a number of other countries.
Yeah, so good question. This is an issue that has come before the committee periodically. I think the most recent discussions were last October as part of an ongoing monetary policy framework review. And we look at the efficacy of any particular tool for whether the monetary policy transmission mechanism works the same or differently, whether negative rates could have adverse effects on the financial system, for example, by impairing market functioning. Of course, we're interested in the experiences of other countries that have implemented negative rates. And I will say that, my own view, which has not changed a great deal, is on balance, the cost benefit is not attractive on negative rates for the US. There's mixed effects in terms of how much pass-through you see. The effect on bank lending appears quite varied by country. And the structure of the banking system appears to matter a great deal. So it's not clear how that would translate into the US. And of course, there could be some impacts on money market functioning that might make it a less attractive balance of costs and benefits. But generally speaking, in my view, the cost benefit just is not attractive in the US context.
Well, I very much appreciate that perspective. And as I look through the questions that the audience is sending, there's a number of them that go around the balance of fiscal and monetary policy and the current budget deficit, its size, the fiscal outlook. Quite understandably, we've had a very large expansion in the federal budget deficit, and monetary and fiscal policy seem to be working hand in hand. I wanted to maybe get your thoughts on, as the economy hopefully begins to recover, and well, we're a long way from full employment, but as it hopefully recovers over the next few years, how should we be thinking about the balance of those two, and where might there be tension between fiscal and monetary policy down the road?
Yeah, so it's a good question. I mean, I think as I think about the case for fiscal and monetary, we have to remember that the pandemic represents the biggest shock to the US economy in modern times. We went from the lowest levels of unemployment in 50 years to the highest, and we did so in the space of a couple of months. So in my mind, that is exactly why you use stabilization policy, both fiscal and monetary policy, when you have the capacity. I think the response, as I said earlier, on the fiscal side was large and forceful, and it moved quickly, and that is appropriate. And similarly, I think it was appropriate for the Federal Reserve to use its tools to move forcefully and at scale. You can see the results of those actions. I think the fiscal actions, as I said earlier, you can see some correlation between the arrival of some of those payments and actual spending. There's clearly an important impact in the small business sector. There is clearly an important impact in terms of unemployment payments and deferral of tax payments. And that has helped to shore up household incomes, business incomes, and the labor market. The question going forward, I think, is will it remain appropriate? And as I've said, I think the recovery, even in the absence of some of the downside risks materializing, the recovery faces headwinds. And fiscal support will be necessary for some time. And of course, if we saw rolling flare-ups or a second wave scenario, it would become all the more important, both to shore up demand and to avoid that kind of long-term damage to the productive capacity of our economy, the scarring in the labor market.
And I very much echo your comments about the importance of the transfer payments. We've done survey work of renters and owners, and it's really been key for them to be able to keep up their rent payments or keep up their mortgage payments. So there's no doubt at all. I didn't mean by the question to be dismissive of its importance. It's been really vital. As I look through the questions, there's also some tension or theme that runs through about, on the one hand, we've seen asset prices do fairly well, and there's been a discussion in Europe and in the US about how to balance the full employment and low interest rates to help that happen. But at the same time, you see asset prices going up pretty strongly, and that benefiting higher income, higher wealth households. And at the same time now, we've got new tools that the Fed is using that the questions are referencing, which target a little bit more Main Street, or maybe target the really more closely the fine-tune the targeting of policy. And so there's a number of questions asking whether some of those tools might be useful to either help small business in the recovery, or might be useful as a means to target employment. As you noted in your comments, African American and Hispanic unemployment rates were really starting to come down in the last couple of years. And that has been cut short given the sectors of the economy that many minority households and labor market participants work in. So I'm sure everyone would love to hear your thoughts on those subjects.
Yeah, so I think we are very attentive to the impacts on different groups, particularly groups such as Hispanic and African American workers that have traditionally faced barriers in the labor market, where we've seen persistent gaps in terms of labor market outcomes. Our monetary tools are blunt, but as we were discussing earlier, in the environment that we find ourselves in currently, with the sensitivity of inflation to labor market tightness much lower than it has been historically, we really saw in the last recovery, and I think we'll see again, that we can support a recovery in the labor market that has that same kind of depth and breadth that we saw late in the last recovery, where we did start to see finally some narrowing of those gaps. for Black and Hispanic workers. We have other tools where we get at some of those issues. We have responsibilities, for instance, in fair lending. We have responsibilities on the Community Reinvestment Act, which do try to get at redlining and some of those historical inequities. Our emergency facilities are intended to support the flow of credit to households and businesses generally. And so you're exactly right that we played a supporting role on Paycheck Protection Program in terms of our liquidity facilities. We have a Main Street program that is intended to target that middle-sized employer. And then, of course, our corporate credit facilities are better suited to targeting, providing some market support for the largest employers. So we're really trying to make sure that our emergency facilities are restoring private flows of credit, whether that be through capital markets, through banks, or other mechanisms. And we're doing so in a way that's very targeted on where are the big employment potential impacts.
And I know that in your past work at the Treasury, you were very focused on international affairs and were essentially our most senior diplomat on many of those issues. We've focused mostly on the domestic economy during this conference, but I'm wondering what thoughts you might have about things you think that as business economists we should be watching around the world, and if there's any issues on the international side that you think are being underappreciated, both in the current environment and then, you know, we will get through COVID, and then once we come out the other end.
Well, I think we do know from the last crisis and the last recovery how important the global economy is to the U.S. And how important global financial markets are to the stability of financial markets in the U.S. So I think we have learned that as we conduct monetary policy, we need to do so in a way that is cognizant of those spillovers. I think, for instance, you know, we saw disruptions in financial markets not only in domestic financial markets, but we saw some in cross-currency markets. And we know from the last crisis just how disruptive those kinds of disruptions to foreign exchange markets can be, and how they can come back around into the U.S. economy. So that's an area where the committee moved very quickly to stand up swap lines with a large number of countries where we had already established swap relationships. You know, we made sure that those had much greater flexibility, better pricing. And then we went further and established repo facilities for some foreign central banks to help support the U.S. Treasury market, because we understand just how important the liquidity and depth of the U.S. Treasury market is globally. And, you know, those interventions, I think, were welcomed internationally. They made a big difference here at home. We saw those measures of dysfunction in those markets quickly coming back down, and the usage of those facilities commensurately will start to come back down as well. So I think the biggest, you know, the biggest lesson is just how important it is for us to be aware of our role in the global economy and how big a effect the global economy can have on us.
So in your prepared remarks, you noted the supply chain disruptions that have happened around the world, the excess capacity that exists around the world. And then coming into this, obviously the economy, as you noted in another answer, we had a drop off in business fixed investment for 4 quarters, and we had a lot of trade tensions. And when I sort of look at this mix, we've got some items that are maybe in the long run a little bit inflationary. If we look at the last few years, the tradable goods sector tended to a deflationary impact on the economy. Housing sector, healthcare, and education, with its less import competition, obviously was where some of the inflation was coming together. As you look out into the future, what's your sense of what the balance is from the deflationary pressures from abroad and the disruption to supply chains, and how we should be thinking about that?
Well, you know, it's a good question. I think initially people were anticipating potentially a lot more of pressures on the inflationary side coming from the supply side disruptions. And, you know, what's interesting is that in fact we've seen a step down in core PCE inflation, both core excluding food and energy and total PCE inflation. Now there's an overlay there with oil prices having also moved down during the same time period for a variety of reasons. But what's been interesting so far is just the extent to which this has been a disinflationary shock, coming on top of, as you said, years in which, despite seeing a very robust labor market, we just were not seeing inflation sustainably getting to 2%, which is why we've spent a lot of time thinking about how do we get that sustained performance on inflation over time at 2%? How do we prevent inflation expectations from slipping? You know, you look around the world and the experience of central banks where they've allowed inflation expectations to slip, it is a very difficult challenge for monetary policy. So, you know, I, for one, am very vigilant to make sure that we have the appropriate policy framework to make sure that we do get 2% inflation on a sustained basis over time, and that we do anchor inflation expectations at 2%. That to me seems like the bigger challenge, the more central challenge at the moment.
And related to that, there was a question asking when we should maybe anticipate seeing the results of the medium-term evaluation of inflation in that part of the mandate. I know that was ongoing, and obviously other issues are more pressing for the moment. But
yeah, so you know, we spent a year not just thinking in a sort of academic or expert audiences about how we should be conducting monetary policy in a way that is attentive to, informed by some longer term features of the economy. But we also engaged with groups around the country. You know, I went to several regions of the country. My colleagues did. We met at a variety of our regional Federal Reserve banks and branches, and we invited panels of representatives of different kinds of groups that represented workers or seniors who might be very sensitive to inflation and to erosion of their savings. You know, we met with community groups and tried to understand how they were experiencing the economy. That work, I think, is in many respects starting to already inform sort of how we think about what monetary policy is going to need to look like in this recovery. But I certainly agree with you that it does have the potential to help shape monetary policy going forward in a way that I think would be quite attuned to how the economy has evolved. So it's been a very, I think, productive conversation. We've had it with the American public generally. It's all out there, as you know, on our websites, and all of the panels are accessible. And so I do think that we want to make sure that that is informing monetary policy going forward.
Yeah, one of the interesting paradoxes there is if you look at the Michigan survey or other surveys of consumer expectations, they're fairly anchored around 2%. They just sort of have this view that inflation is going to be 2%. And you look at the tips, you look at financial markets, and it's such a dichotomy. So it's not at all an easy thing to navigate. There's a number of questions that have come in, perhaps not surprisingly, asking a little bit about the yield curve and forward guidance versus yield curve control, and how you maybe think about those issues and what might be useful in that area.
Yeah, so I really don't, I think about those as very complementary tools. Forward guidance, of course, it has to be at the core of our response. We have substantial experience with it. In the last crisis, there's a high degree of familiarity there, and it provides a very important mechanism for providing accommodation when the policy rate reaches the lower bound, as it has done in response to the COVID shock. So we know a fair amount about how to make forward guidance credible, and how it can provide a strong boost to both the pace of the recovery in the labor market through influencing investment decisions, for instance, and also help to boost inflation expectations back up to our target and to help sustain 2% outcomes over time. And I think as we move forward in pivoting our monetary policy from stabilization to accommodation, forward guidance will play a very critical role. Now, as I said earlier, it is possible to further strengthen our support for the recovery through balance sheet policies, whether those be asset purchases, whether those be targeting the shorter end of the yield curve. Asset purchases and forward guidance are just more familiar. They were used actively in the last crisis in the US. It will take more discussion, more analysis to reach the same level of understanding of the potential role of targets on the front end of the yield curve. So that is something that may become relevant further out. But again, I think the core looking ahead will be that forward guidance. And then we can further reinforce that either through some combination of balance sheet policies and possibly targeting some of the shorter end yield curve, parts of the yield curve that might be consistent with in support of that forward guidance. But that's a conversation for further out, I think.
Sure, sure. And one of the topics that was discussed before COVID a little bit, and it came through in policy, was the balance between purchasing treasuries versus mortgage-backed securities. And going back a number of years, when the Fed started buying mortgage-backed securities, there was also a focus in comments about the spread between treasuries and mortgage rates, and maybe a little bit of jawboning down the market and lenders to get that spread a little back to historical relationships. Looking forward, what are the considerations that might be important in thinking about when to stop buying one asset over stopping to buy the other one, or to have them be in runoff mode as opposed to continuing to reinvest dividends, not dividends, prepayments and interest payments?
Well, let me just say that those are good questions. I right now am entirely focused on navigating through a fog of COVID uncertainty and providing the requisite support for a strong and prompt recovery in employment and the return of inflation on a sustained basis. Of course, we should take into account the degree of policy accommodation provided by our asset purchases, and that does depend on how long the market anticipates that we will maintain those securities holdings. So we do and should, of course, take that into account. If you look back, the elevated securities holdings that were acquired under the large-scale asset purchase programs following the great financial crisis or the global financial crisis were maintained for many years. And we didn't see that gradual passive runoff of securities until well after the committee began raising short-term rates. So right now, given how far away the economy is from our dual mandate objectives, I think the focus has to be to provide sufficient accommodation to return the economy to that kind of maximum employment and that 2% over time inflation performance. And, you know, for a much later date, when we have seen the dual mandate achieved, you know, those kinds of issues, considerations come much more into focus. But for today, the challenge is to provide accommodation and to do so decisively.
Well, it'll be terrific when we get to the day where we're having that conversation.
Indeed.
That is the focus of policy and market participants. Well, I wanted to thank you very much for taking the time to spend this hour with us and answering all our questions. And actually, a number of the questions that just came up were noting how everyone really appreciated the depth of the answers and how much insight you've given us. So we really appreciate it. And I want to turn it back to Ellen.
Great, and I'll just take another minute to thank you so much for the way that you answered each question with insights, and really appreciated your remarks. I know just from the attendance on this call that it was very well received. Thank you very much, Governor, for joining us this afternoon. And we hope those on this call that they're safe and well.
Thank you, both Ellen and Mark and everybody else. I really appreciate the opportunity.
Thank you. So Chris, I think you're going to wrap us up.
Yes, great. Thanks, Ellen. And thank you, Governor Brainard and Mark also for moderating. Before we sign off, I did want to mention that the 62nd annual meeting, NABE's 62nd annual meeting will take place virtually this year, organized around the theme Global Reset, Economic, Business, and Policy in the Pandemic. The event will take place October 5th through 7th. Fed Chair Jerome Powell will keynote the event, and registration is now available on NABE.com. Also, the 17th Annual Economic Measurement Seminar presented by the NABE Foundation is a convenient, cost-effective program designed to strengthen your knowledge of economic statistics and analytical techniques, enhancing your ability to add value to your workplace. This year's EMS will take place virtually August 31st through September 2nd, and registration is also available on NABE.com for that event. As a reminder, recordings of past webinars are available on the NABE Connect app, which can be downloaded in the App Store and through Google Play. NABE members can also access webinar recordings and handouts through the NABE.com digital archive. If you're interested in becoming a member of NABE, please go to NABE.com/join for more information. Thank you all. That does conclude today's event. Today's program is copyright 2020 by the National Association for Business Economics, with all rights reserved. This does conclude the event. Thank you all. You may now disconnect.